Welcome, everyone. We have a lot to jump into in this episode. As you may have heard, Jerome Powell, the money printer man, has come out and said, hey, the fun may be over, right? The party's got to stop at some point. The spiking of the punch bowl indefinitely, is what it seemed, may actually be coming to an end. And it might be coming to an end at the end of this year, a little bit sooner than investors expected. In fact, we have an article out just yesterday from CNBC that says stock futures are flat after the market sell-off amid Fed's taper discussion. Right now, the Fed, Jerome Powell, are in discussion of how aggressively and quickly they want to discontinue supporting the market. So if you haven't been aware, the Fed has been supporting the market pretty aggressively. And most people don't really understand how aggressively the Federal Reserve has propped up the stock market. They've basically taken the stock market and they said, oh, you're about to collapse, right? Because of the 2020 crisis, all these companies' stocks are about to go down. There's not any liquidity because a lot of people are going to be selling all these bonds and there's no way for them to sell it if there's no buyers. So the Fed's going to be the buyers. The Fed's going to save the day. And that's exactly what they did. Check out this image here. This is the Fed's balance sheet over the past 15 years. We can look back in 2008 and see this little bump up. That was the big bailout. That was the big bailout of the banks. This was the aggressive Fed action in 2008. It doesn't look like much because then we get to 2020 here and look what happens. It's like 3 times the amount that it goes up. And then it doesn't stop there. There's a minor dip, but the Fed continues to buy aggressively, expanding their balance sheet. And they're buying treasuries. They're buying bonds. They're buying things that at the time investors don't want any part of. They're just selling out of these as quick as possible. This has been going on for a while. And a lot of people believe that this has been artificially supporting the stock market. And just yesterday, the Fed said, we think that we're going to actually end this practice pretty soon. Now, with that said, we also have some other things going on. There's some investors that are pretty big into the macroeconomics, into interest rates, into inflation. They know how these type of things are evolving and they take advantage of it. One of those investors is Michael Burry. He is someone that's very good at looking at macroeconomic trends and making bets that pay off big with those trends. And notice what Michael Burry is doing right now. I'm sure you've heard the news. He's very popular. This has been blasted all around social media for the past couple days. The Big Short investor, Michael Burry, that title bothers me a little bit. It says Big Short investor. This guy has done so many successful bets outside of the Big Short. If you read about his history, he's extremely successful outside of the Big Short. Even if that never happened, he'd still have done very well. But it says that he's betting against Cathie Wood's ARK Innovation ETF. So not only is Michael Burry still short on Tesla, which is surprising. He actually doubled down on his short position on Tesla, but now he's betting against the ARK Innovation ETF as a whole, the entire ETF. He looked over that ETF. He saw that ARK Innovation has a negative earnings yield. It's a lot of these companies that have earnings way down the road, and he's betting against the whole thing. And this follows along this whole theme. It follows along the theme of the Fed tapering asset purchases, Michael Burry betting against these type of companies. There's just a lot of macroeconomic trends moving away from these high growth companies. So where does that leave us with the story fund? This portfolio, in many cases, is somewhat similar to ARK's portfolio. It's not an exact match. I would say that I have a lot more companies that have actual positive earnings. Apple's highly profitable. I don't think that ARK has any Apple in it. Microsoft is highly profitable. Facebook is. And Amazon is, Google is. I have all the big tech companies that are highly profitable. They have very positive earning yields, and my portfolio is heavily weighted towards those companies. So these aren't companies that are really the type of companies that Michael Burry's betting against. In fact, I think that he's very bullish on Facebook. He has call options on it. So these type of companies that are profitable companies, Michael Burry is bullish on those. He thinks those are going to do fine because their earnings are very close. The type of companies that have their earnings way out in the future, the type of Tesla-esque companies, CrowdStrike, Snowflake, DoorDash, Peloton, Square, Shopify, CLTD, PayPal, these type of companies that have their earnings way down the road, 10 years down the road, those are the type of companies that Michael Burry is betting against. Those are the type of companies that this news it usually affects in a negative way. What happens if the Fed doesn't support the markets anymore and they raise interest rates? That should negatively affect companies that have their earnings way down the road. In fact, we can read more about this phenomenon of interest rates and the effect it has on growth stocks and companies that have their earnings far out in the future. This is from the strategic director at Buckingham Wealth. He says growth stocks have longer duration than value because they have more of their earnings farther out. So again, a company that earns a lot of money right now, like Apple, a company that has high amounts of cash flow like Berkshire Hathaway, those aren't going to really be negatively affected as much as companies like Snowflake, that they're not earning a lot of money right now, but they should have profits out in the future 10 years from now. So companies like Square, PayPal, even Tesla's profitable right now, but not really compared to what it's trading at. All the profits for Tesla are mostly in the future. And any Tesla investor would say that. They'd say, I'm not investing for the profits right now. I'm investing for the profits 10 years from now. This is what the effect is. Companies that have their profits further out into the future, they have to be discounted by rising inflation. He says, quote, if you get rising inflation, you have to discount future earnings. So that's the phenomenon that's going on right now. And you can see the effect this is having on the market overall. The type of portfolios like ARK Invest, they have a lot of these high growth technology companies with very, very low earnings right now. They're getting crushed right now. Look at ARK Invest's year-to-date performance against the S&P 500. The S&P 500 is up 19% year-to-date. It just continues to climb up more and more every single day. It has almost no volatility. It has a lot of these kind of value stocks, profitable firms like all the big tech companies, and it's just like a straight line going up. It's pretty incredible. Meanwhile, the ARK Innovation ETF is actually in the red by 7% this year. So that is a little bit of a look at the macroeconomics and how it has different effects on different types of companies. Just to review, this might be confusing for some people. Why do you have to discount future earnings? Earnings that are farther out in the distance more when the interest rates go up. The reason why is because everybody invests in a company primarily. Every single investor is investing based off of future earnings. So you buy a company now based off of what it's going to earn over the next 10 years or 20 years or over the life of that company. That's what you're buying when you buy a company. You're buying future earnings of that company. Now, if a company has all of its earnings 10 years out and the interest rates are zero, there's not a lot of competition because there's no way to earn free money right now. There's nothing you can invest in without risk to earn easy money right now. But let's say that Jerome Powell raises the interest rates from zero, effectively right now, to 1%, to 2%, to 4%. All of a sudden, there's a new game in town. There's a way to have returns without taking on risk, and that is the federal funds rate. The higher that goes, the higher the risk-free rate goes. And the higher the risk-free rate goes, the more appealing it is to just earn money that way. You can earn 4% risk-free right now. Why take on the risk of investing in companies that might have their earnings not work out in the future when you can earn money risk-free right now? So if the interest rate goes up to 4%, you can earn 4% risk-free right now. If it goes up to 5%, you can earn 5%. What if it went up to 8% and you can invest in treasuries at an 8% interest rate? That would make it so it'd have to be incredibly good of a story for a company to have better risk-adjusted returns than that risk-free 8% right now. So as the interest rates go up and up and up, the value of the future earnings of growth companies contracts more and more and more. Those companies have to show that they will earn so much more than what the risk-free rate is to be worth it to invest in it. Because those earnings down the road is unknown, and the risk-free rate right now, that interest that you can earn right now, is known. There is no risk to it. So that is the correlation. Companies that have their earnings farther and farther out into the future, they just have to be so appetizing. Those earnings have to be so good to take that over the risk-free rate as that increases. Now, Jerome Powell is signaling to investors that risk-free rate might be expanding because inflation's going up. And as inflation goes up, the one way they have to combat that is by rising that risk-free rate. So he's signaling to investors that it might be a good time to lessen your exposure to these growth stocks that have earnings way out in the future. And that makes sense. It makes sense that Michael Burry would be bearish on ARK Invest and Cathie Wood. A lot of people read this news and they think, well, he's just kind of a dummy, right? He got lucky once. He got lucky with the housing boom. He made one good play, and now he's just a perma bear, and he thinks he can repeat it. First of all, that's not accurate. Michael Burry's not a perma bear. From 2001 to 2005, he was a bull. He made a lot of money in bullish picks, and then he became bearish on the housing market. He was correct. And then he became bullish after 2010 for another 7 years until about 2017, where he started to become bearish again. So he's not a perma bull. He's not a perma bear. He's just an investor that looks for value. Right now, Michael Burry understands that there is a very good chance that interest rates will have to be raised, which makes these companies with their earnings way out in the future, like I just reviewed, like we just went over, as the risk-free rate goes up, those earnings become less appealing because there's risk associated with these future earnings. So those ones become less valuable. ARK Innovation, Cathie Wood is saying Michael Burry doesn't understand innovation, yada, yada, right? She's on Twitter trying to defend her ETF. Michael Burry doesn't care about these companies or the innovation. That's not a concern to him, what these companies are actually doing. All he's done, I guarantee you, is he's looked at the ARK Innovation ETF. He's gone through and said, this is basically just a pool of unprofitable companies. In fact, if you went through and added up the actual earnings yield of all the companies in the ARK Innovation ETF, the earning yield overall is negative 1.2%. So overall, as a group of companies, the overall earnings yield is negative with ARK Innovation ETF. With the S&P 500, for instance, the earnings yield is 3.5%. So SPY has a positive earning yield. If you're investing in SPY, overall, you're investing in very profitable companies. In fact, almost every one of them is profitable. That's one of the things that has to happen before you get into the S&P 500. But with the ARK Innovation ETF, since that's ran by Cathie Wood and she invests in innovation, she invests in many unprofitable companies where their profits are way out in the future, the overall earnings yield is negative. So Michael Burry is sitting there thinking, I know that unprofitable companies that have their profits way down the road are going to be less valuable if interest rates go up dramatically. And obviously, this guy believes that interest rates are going up because he thinks that we're facing a lot of inflation. He said that very publicly. So that's all I wanted to do, is jump in here and explain what's going on with this situation. If the Fed decides to increase interest rates, Michael Burry will likely make a lot of money shorting Tesla, shorting the ARK Innovation ETF. If it doesn't play out that way, if they keep interest rates incredibly low for a very long time, then he very well could be at the wrong side of this deal. He could lose money. So with all of this news, where do I stand on this? What am I doing with my portfolio? In my case, I actually agree mostly with Michael Burry. I think that he'll be proven correct on this. And the reasons why is he's predicting that the Fed is going to have to raise interest rates. Their hand is going to be forced. There's too much inflation. They have to increase interest rates. And if and when they do that, it'll make these companies, especially the not profitable ones, the companies, again, with their earnings way out in the future, it'll make those be discounted. So I think that those two basic assumptions for Michael Burry have a very high likelihood of being proven correct. So what I've decided to do in my portfolio as a result of going over this is to focus on holdings that have profitability, companies that are making money right now, not companies that only have their earnings down the road. I have a couple companies that only have their earnings down the road. They're companies like CrowdStrike, Snowflake, DoorDash, Peloton, Square. A lot of these companies aren't making a lot of money right now. They're trading at very high multiples. And all of their earnings, if they ever do become profitable firms, all of their earnings is down the road. These type of companies are likely the ones that are going to be hurt the most if the Fed comes out and says we're increasing interest rates by, 0.25%, right? These type of companies will be hurt. So what I'm doing as a result of this is I'm just putting a bigger weighting on companies that are highly profitable right now. And many of those are tech companies. It's not true that every tech company is unprofitable and every tech company has all of their earnings out in the future. There's a lot of companies in this portfolio that are profitable right now and very profitable. Companies like Apple, Microsoft, and Facebook are extremely profitable. So those aren't ones that I think will be dramatically hurt with an increase in inflation because they have cash flows right now. So that's my plan. That's what I'm doing. I'm going to be focusing on companies and firms that I think have a high amount of profitability, and the ones that have their earnings way out in the future, even if they're growing, I still might include those in the portfolio, but I'll weight those down to be smaller positions in my portfolio. Now, overall, if we compare the S&P 500 against the Story Fund, accurately benchmarked against each other, this is my portfolio in blue against the S&P 500 in red. They're almost completely tied. As of 1 hour ago, they're literally tied neck and neck, like within a fraction of a percent from each other. So they both have given around 20% returns since inception of this portfolio. That's what it looks like. Now, if I was a betting man, if I was going to guess the short-term movements of the stock market, I think that the story fund will dip below SPY in the short term, because right now people are really scared about these growth stocks. There's speculation of the rising interest rates, of inflation, and all of that means that people move out of these growth stocks into more value-oriented stocks, and I could see that going on for the next few months. But over a longer term trend, the companies themselves will be the ultimate deciding factor, and I'm very bullish on my companies. So that is an update. I hope that that makes sense. I hope that that fills in a little bit of what's going on with interest rates, with Michael Burry, with Cathie Wood, with these type of growth stocks against value. If you enjoyed this type of content, be sure to check out the Patreon. I'm on the Discord every single day. We have lots of exclusive content and fun people to talk to. So I'll see you on the Discord, or otherwise I'll see you in the next video.